Well, it's 12:30 p.m. almost, or maybe a minute past that on Wednesday, and we are on with the mutual fund show with a gentleman who needs no introduction, from a fund house who needs no introduction, has created tremendous amount of wealth. The question is, what's the way ahead? What should people who are either first time investors or regular investors do with the mutual funds? To answer all of that, on the mutual fund show at Bloomberg Quint, we have Harsha Upadhyaya of Kotak. Harsha, thanks so much for taking the time out.
Thank you.
You know, a clutch of our viewers who we've now regularly getting on the show almost every Wednesday, they tune in to try and figure out what should they do with mutual funds, etc., have this basic question of why is it that they should go in for mutual funds vis-a-vis the other forms of investment. And we're not talking real estate, but other forms of financial investment. Let's drill it down to the very basic. Why should people choose mutual funds?
I think when you invest in mutual funds, you get professional investment management for a very small fee. Compared to many other products that are there in the market, mutual funds often come at a very, very small cost to anybody who invests into it. And you get a diversification benefit, which on an individual basis you may not be able to do it. For example, if somebody wants to invest the minimum amount in a mutual fund, which is 5,000 rupees, he or she may not be able to really diversify into many stocks using that 5,000 rupees.
Sure.
But when they come into mutual fund, whatever be that sum, they get the entire benefit of the entire portfolio, which is very well diversified. So to that extent, they can manage the risk very well. And obviously, the fund houses have the professional research as well as investment management teams. So you also get the benefit of professionals who are tracking some of these sectors and stocks on a 24/7 basis.
Now, I know past returns are not a guarantee for what future returns could do, and we'll come to the Kotak returns in a bit. But by and large, for a decently well-managed mutual fund house, is there an estimate or is there a base number that people who are investing in the funds could work with? I mean, let's say somebody who's right now wanting to invest money and he's at just the start of his investment or earning cycle. What's the kind of returns that such a person can expect from the AMC industry?
See, first of all, none of the mutual fund products have any guarantee.
Of course.
So to that extent, investors will have a different experience compared to fixed deposits where they're assured of a particular return. Having said that, there are different asset classes within mutual fund basket. For example, I come from the equity side of the business. Equity is for more longer term wealth creation. Over a period of time, even if somebody had just invested in Sensex or Nifty without even going into mutual funds, they would have made returns in the mid-teens on a CAGR basis over a long period of time. Obviously, each fund would give different return depending on what the portfolio is. So that's on the equity. So there is no guarantee that the past performance could be repeated in the future. I'm just giving you a guidance in terms of how past has been.
Sure.
If you look at the fixed income funds, they will give you slightly better returns than a fixed deposits. So that's how, if you look at the risk also, the fixed income funds will have lower risk, the equity funds will have higher risk. Even in terms of return potential, potentially equity funds can give you better returns. But ideally we suggest investors to do the asset allocation first, which means they have to decide based on their risk-taking ability and their return expectations. Have a allocation between different asset classes. So within mutual funds, you can decide to put some money in equity, put some money in fixed income. Then after that, depending on the risk within equity, which category of funds you need to choose. For example, the most conservative investors either go for index or ETF funds, which just replicate the index.
Right.
So you don't have any fund manager risk, you don't have any fund house risk. At the same time, there is no outperformance over Sensex or Nifty. So whatever returns you get in the market, whatever you see on a daily basis in terms of returns, that will come through in terms of your NAV growth. Then slightly more aggressive investors would go for large cap funds, which essentially mean you are investing in blue chip companies on a diversified basis. And obviously it will not invest in all the Sensex or all the Nifty stocks. So to that extent, the professional fund management is expected to deliver better returns. As you increase the risk profile, then you go to multi-cap funds, mid-cap funds, then maybe sectoral and thematic funds. So on the equity side itself, you have various categories of risk, and potentially risks also, the returns also change as you go into different categories.
I'm sure. So higher the risk, higher the return could well hold true in mutual funds as well. Potentially, yeah. Now, just before we get to themes about how to select a fund as well, because that's something that we want to ask Harsha. Last week, we had a couple of mutual fund advisors who were here. And they were of the opinion that if you are a first timer or if you don't know too much about mutual funds, don't go out and blindly invest money in a particular category, so on and so forth. Maybe it is better to consult an advisor, because even mutual funds are not easy to pick. There is lot of diversification or a lot of categories within the mutual fund industry as well. Is that something that you as a fund manager also subscribe to, or would you believe that online investing is
as
just a great
mutual
idea?
fund, we completely believe in this philosophy wherein every investor needs some kind of a professional advice in terms of choosing which asset class to invest into and also which kind of funds to invest into, because for a common person it is very difficult to decide in terms of asset allocation, in terms of what the risks look like, and which funds to potentially enter into.
Right.
So to that extent, unless somebody is so proficient and is able to give 24/7 research time on selecting funds, it's always beneficial to go through a financial expert who is trained in that category to actually plan and also advise financials.
And we'll scratch this point a bit later on in the show as well. Online, there's a lot of option available for people to do direct investments online. So if you know your mutual funds, if you know them well, maybe online could be the way. But firstly, Harsha, for a very basic investor, what are the factors that he or she should take in mind before choosing a mutual fund? I ask this question simply because I'm just saying, if you scan through the number of AMCs available, and a lot of them are doing very well, there are probably northwards of 45 asset management companies. Correct. And a few of you are really well known, some of them not well known. How does one choose a mutual fund house?
Yeah, first and foremost, I think the fund house pedigree and how stable and experienced is the investment management team is what determines
this information
success.
Is available online.
Yes, this is available. I mean, these days every information about the fund house as well as the team, everything is available online. Each of the asset management companies have their own websites where all these information is given.
Sure.
Or if you go to a particular fund and look at the fact sheet, it also carries a lot of these informations. So it's not difficult to get. So that's one part. And then you need to decide what is your own asset allocation and investment philosophy.
Okay.
Or you need to take the help of a financial advisor, which I would say is the preferred route. Once you decide your asset allocation and the kind of risk that you are willing to take, then you need to see which of the investment philosophies will go with your style of investing.
Sure.
Because there are, for example, if somebody has a horizon of just, let's say, 6 months, naturally the equity funds are not right for that particular investor. So equities are more long-term in nature in terms of investment horizon. So whether it matches with your risk profile, whether it matches with your investment horizon. So these are some of the things that you need to see. And then about the portfolio itself. How diversified is the portfolio? What are the risk metrics? What has been the past performance? What has been the track record? It doesn't mean that the past performance can be repeated in the future, but at least there is some guidance in terms of what has happened in the past, whether in a previous cycle, whether the fund management team has been able to deliver risk-adjusted superior returns or not. So these are some of the things that you need to look at. But these are, I mean, I've just given you a few points. Obviously, it's a
wide basket.
Yeah.
Okay. One small question that a lot of people typically tend to ask is whether they should do, and let's assume from a current perspective, current point of time, whether they should go for a lump sum investment in mutual funds or should they choose the SIP route. Assuming that the availability of money is not a concern,
right.
Is a lump sum investment better or is it SIP better?
See, it's always been proven that timing market is always difficult.
Very difficult.
If that is the case, then one should not try to time the markets by trying to put money on a lump sum basis.
Sure.
It always helps to stagger your investments because you are able to beat volatility through time, through passage of time. Even if there are volatile periods in the market, you will at lower levels you will probably buy more units. At higher levels you probably buy lesser units. So over a period of time you accumulate fund units at a reasonable NAV, and as business improves, as economy improves, you start gaining over that. So usually we advise investors to go through a staggered, disciplined approach because discipline is very key for equity investing. A lot of people make the mistake of getting in too early or getting out too late, etc. So if you have SIP kind of a philosophy, which is more staggered in approach, more disciplined in approach, it always helps.
And it probably doesn't hurt because a small amount goes out of the pocket every month.
That's again a benefit.
Or every week or whatever the frequency you choose.
As you keep getting your monthly income, you are also parking some money into these investments.
Yeah, probably that's a great. Okay, so now we had a few requests from people in terms of recommendations that they would want. So, firstly, a recommendation for somebody who is a risk-averse investor. What kind of equity fund should he choose? Is there a fund that exists in the Kotak stable, which a person can choose as well?
Yeah, for a risk-averse investor, I would assume that he wants to take zero risk on the market volatility. If that is true, somebody can come into arbitrage funds. These are essentially equity products. They have the same taxation as equity products. It's definitely an advantage. So anything, any returns coming from that fund post 12 months has zero tax, and also the dividend coming out of that fund, which is mostly regular in most of the arbitrage funds, is also tax free. So what it does essentially is the money that comes from the investors, we buy stock of a particular company, let's say company ABC, we buy 1,000 shares of ABC, and we go and hedge 1,000 shares of ABC with its own derivative.
Okay.
So there is no market risk. Irrespective of markets ups and downs, this fund is going to give you the spread that was locked in at the initiation between the cash price and the futures price of a particular company.
Okay.
So it generally moves in line with the short-term interest rates. The advantage is there is no tax. If you hold it for 12 months, you don't pay tax. So without getting affected by market volatility, you are able to generate higher returns than a fixed deposit, for example.
And it is tax-free.
Yes.
Okay, so it's almost about a 30% higher return than what a fixed deposit can give you. In a manner of speaking, because you're saving on the tax if you save for more than 12 months. Okay, so there's an arbitrage fund, and I do believe there is a Kotak equity arbitrage fund, which if I'm not wrong, over a 5-year period has given returns northwards of 45%, 45, 46% if I'm not wrong.
Cumulatively, which means about 8% odd on a CAGR basis.
CAGR 8% return.
Yeah, which is again tax free. So none of the fixed deposits will actually give you that.
Right.
And it has zero risk on the market.
Okay. So mind you, Harsha is not recommending a fund, but the fund that exists within the Kotak stable is a Kotak equity arbitrage fund. So for a risk averse investor, this could be a good fund, cumulative 45-46% return. CAGR about 8%, which is tax free. If you held it for 5 years, it's obviously tax free. So that's the kind of return you could have made. No guarantee for future returns, but this is a good example of what money invested in an arbitrage fund could do. Now, what if there is a fund or an investor who is not very risk averse, but is a bit conservative? So this could well be a guy who's say maybe 50 years old, not wanting to take too much risk, but has got some money backing him and therefore okay with a little bit of risk, just a bit conservative in nature. What kind of funds should such a person choose?
Yeah, such people who are coming to equity but not willing to take too much volatility of the equity markets, we generally advise them large cap funds or large cap oriented funds, where the scripts are generally blue chip in nature. The businesses have been there for decades or longer. The established businesses, hence you will probably not have too much of a problem in terms of companies losing out whenever there is a business cycle, etc. And also from a common investor perspective, they get to see the same names that they are well versed with in terms of what companies the funds would have been invested into. So there is that kind of comfort as well. If you are in a large cap fund, you know most of the companies that are there in your fund portfolio as well. You would have been using some of their products, you would have seen some of their products. So that's an advantage. So I mean, it comes with higher risk than an index fund, but being large cap, being stable over a period of time, those businesses don't show the same kind of vagaries as some of the mid caps.
Would these returns make a nifty ETF return for that matter?
As active fund managers, we always try to beat the benchmark that is there, the respective benchmarks of each of those schemes. So most of the large cap funds have benchmark as either Sensex or
the Nifty. Yes.
So the endeavor from active fund manager is to beat that index. Whether portfolio managers are able to do it or not, only future you will come to.
Okay. I must say out here, so there is a question that has come in. There are multiple questions and I'll read out a few of them, but a question that has come in from Ram Kumar Rajaman is, there are two questions, but I'll go to the second one first, which is, can I know a few good funds which is large, mid, small cap in the current scenario? Now, Mr. Ram Kumar, if you would have tuned in the show last week, you would have had a couple of advisors advising you across mutual fund houses which are the best funds to invest in. Maybe you could do that the Wednesday after next as well, wherein you'll have a couple of mutual fund advisors coming in and telling you what funds to bet on across the houses. But I have some information for you out here. from a large cap perspective, taking on Harsha's answer, from the Kotak stable, they have a couple of funds that a couple of schemes that I can see. One of them is a Kotak 50 fund, a Kotak Classic Equity Fund, and there is a Kotak Select Focus Fund. Am I right?
Correct.
These are large cap oriented funds.
Large cap and large cap oriented. Select Focus, for example, is a multi cap. It has little bit of mid and small cap.
Okay.
But predominantly large cap.
Predominantly large cap. Now, here's the thing. Our team has found out the returns which these funds have delivered over the last 5 years. It may not be an exact replica of what Kotak might be able to do over the next 5, but the Kotak Select Focus Fund, which is the multi-cap fund, has given cumulative returns of northwards of 180% over 5 years, if I'm not wrong. You can do the CAGR math yourself. And the Kotak Classic Equity Fund, 114%, a much less riskier fund than the Kotak Select Focus Fund, so to say. And the Kotak 50 Fund, which I presume would probably be choosing companies from the Nifty 50.
Essentially the blue chip. Nifty 50 and slightly outside Nifty.
Maybe the top 100 companies, so to
I
say.
would say that, yeah.
And that fund has given returns cumulative of 123%, which I presume on a CAGR basis would easily be northwards of 15%.
Yeah.
Would be probably 18 odd percent if I'm not wrong.
Correct.
Yeah, so these are the kind of returns that have come in from the Kotak stable. So, you know, Harsha and his team are very well known in the circles, and if you believe in the Kotak stable, then these are 2 or 3 funds from the large cap end that you could do. The Kotak Select Focus Fund is a multi-cap fund, so you wanted a recommendation for a mid-cap or a small-cap fund, so to say. May not be an exact replica, but a multi-cap fund gives you the access to all market caps, and therefore that's an option that you could choose as well. Any other tips that you have, Harsha? I mean,
no, I think any investor who is looking at equity, we always suggest them to keep the investment horizon as long as possible.
As long as possible.
Usually, it's better to attach that with a particular goal that you have in your life, rather than trying to get out of equity.
So I want a USA holiday in 5 years, so I invest a particular sum of money.
A child's education, child's marriage. It could be anything.
Marriage. It could be anything. Okay, great. Now let me take this a step further, because one Mr. Ramkumar has also asked. I think a couple of other people had asked. Somebody had sent me a question. Mr. Padawan had sent a question that he wants to invest about 10,000 rupees a month for his daughter's marriage. Now, let me break this up into 2. One is for a risk-oriented investor who is willing to take, mid-cap and small-cap focus, and one is for somebody who's got a specific goal, as you mentioned. Should a specific goal-oriented person, daughter's marriage is a very prestigious thing. You got to be a little bit safe as opposed to completely taking on risk. What should such a person do?
No, I think in both cases, since the investment horizon is going to be longer than 5 years, I presume.
Yes. So
then I think the equities are better options. Over a long period of time, equities beat inflation, and not only beat inflation, but beat the expected returns of most other asset classes. So from that perspective, I think one can choose different categories of funds depending on the risk profile. But essentially, the bulk of that money should go into equity mutual funds.
Go into equity mutual funds. Now, I would guess that by design, if somebody is a risk-oriented investor, his investment should be in funds which have got a larger equity focus. I mean, within that fund as well, he could probably allocate, if it's possible, 100% to equities. That's possible, right?
That's possible. But even if he doesn't want to do that 100% into equities, he can choose higher weightage to equity assets, equity funds, and a lower weightage to fixed income, which gives kind of a steady returns.
You would recommend that even in a small cap fund, Harsha? That, I mean, if it's a small cap or a mid cap oriented fund, you would still recommend choosing some bit of debt exposure?
See, usually what we say is any investor who is investing in financial assets should not put all eggs in one basket.
Okay, fine.
So right now equities may be looking good, maybe in the past 3 years, 5 years they have given fantastic returns, but there is no guarantee that some of these will get replicated or other asset classes will not do well. So it's like having dinner, having everything on your plate, which is a complete meal. So to that extent, I think having equity, debt, gold, real estate, everything helps. But within equity, depending on the risk, you could go for either large cap or mid and small cap, or a combination of these two, which is essentially called multi-cap funds.
Multi-cap fund. Okay, great. So that's the answer for you, Mr. Ramkumar, as well as Mr. Padawan. Couple of funds that are there within the Kotak stable. The Kotak mid-cap fund has given an astonishing over 200% returns over 5 years, 211% if I'm not wrong. Well, the CAGR numbers would be northwards of 30, I would presume. My math is a bit weak here, but northwards of 30 should be a good timeline. The Kotak Infrastructure Fund, which I think is a thematic fund, is probably given returns of 132%. Can people now invest in infrastructure funds? I'm just asking because infrastructure seems to be the next big theme, but a lot of companies have already given returns.
Yeah.
Is it a good idea to invest in infra funds?
Maybe I'll take a few minutes to explain the thematic funds.
Sure.
We have infrastructure funds. Similarly, the industry may have various other themes to invest into. What investor needs to understand is these are themes which will not make you wealth consistently for a long period of time, but if that particular investment theme works in a span of maybe 5 years, 7 years or a decade, you will make more money than a diversified basket. But at the same time, since it is focusing on a particular investment theme or a particular sector, the risks are more than a diversified fund.
Okay.
So usually we advise investors to go into these funds not more than 5 or 10% of their investments. So in case of infrastructure as well, this is what we believe. While there is enough policy push from the government today, the pace of execution of some of the projects which are funded by state government and central government are picking pace. There seems to be a clear 3-5 year course as well in terms of how this industry can shape up. And we have bet on some of the early cycle plays within infrastructure. We have not looked at companies which have balance sheet issues or capital issues because of the previous cycle. If you look at our portfolio, we are focused more on steady cash flow generation, not much of leverage on the balance sheet, and it need not necessarily be only infrastructure. It could be allied sectors. For example, cement is an allied industry for infrastructure. So we are essentially looking for companies which have a bigger canvas to work with in the next 4-5 years in the infrastructure space, and also have steady cash flow generation, have very strong financials and management bandwidth.
Got it.
So that's the entire basket that we have. So somebody could look at that, but again, I would say it should be for a smaller sum of the entire wealth that he is trying to create.
Okay. Last couple of questions, and one thing that we wanted to ask Harsha is the option of a liquid fund versus a fixed deposit. And there is a question which says that suggest a few liquid funds where I can get 8% and above. So one is it a good option, liquid fund versus a fixed deposit? And two, can liquid funds give returns northwards of 8%? Would there be a liquid fund out of the Kotak stable as well? I'm sure there is, but would returns be commensurate northwards of 8% odd?
See, first of all, it's not a comparable product. For example, the liquid fund has no lock-in. So if you invest today and tomorrow you want to withdraw, you can do that.
Right.
So it's more like a savings bank deposit rather than a fixed deposit.
Fixed deposit, okay.
I can't comment on how the future returns are going to be, but if you look at it from the past experience, they have been slightly better than fixed deposits on a post-tax basis.
On a post-tax basis. Okay. So are these subject to tax though, liquid funds?
Yes, they are subject to tax.
And
so that's the advantage of equity arbitrage fund, which is not subject to any tax if you hold it for 12 months.
12 months, okay.
Yeah.
So pure play equity funds would not be subject to taxation, and the equity arbitrage fund would probably, if you hold it for over 12 months, could be better than liquid funds. Liquid fund would anyways be for a shorter tenure.
In the past, the equity arbitrage fund has potentially given 40-50 basis points higher returns than a liquid fund.
Okay, got it. There is before I ask Harsha the last question, there is a question from Mr. Waqar Ahmed. He is asking that he needs some suggestions on funds where he can invest lump sum 2 lakh rupees and get maximum return. Now, Mr. Ahmed, I would sincerely request you to log in on the same platform a couple of weeks from now, wherein we have mutual fund advisors, and they'll be able to give you an exact idea of which kind of funds should you invest into. I don't think Harsha will be in a position to recommend funds, so I can't really quiz him on that. So you'll have to excuse me there, but I'm sure you'll get your answers, and there could be a number of fund schemes available which could give you great returns. My final question to you, Harsha, is the key challenge for mutual funds, because their penetration levels are very low. Why is it that people are hesitant to invest in mutual funds? Though I do know that a lot of people have started investing in mutual funds in a big way now. The monthly flows show that. But what should people, in your meetings, etc., what is it that people are afraid of, which they don't need to be afraid of?
I think a lot of people don't understand the equity asset class completely. They believe that equity is something which can really give a lot of returns in a very short period of time. Yes, it could give, but that is not what it is intended to do. If you are coming with a long-term horizon, investment horizon, with a diversification in mind, And if you do the asset allocation properly, then equity funds will definitely give you one of the best returns that you can think of.
Okay.
So to that extent, I would say that the awareness levels are still quite low overall in terms of understanding of equity as an asset class, and also the benefits of mutual fund. Because even today, a lot of people who cannot devote 24/7 time on researching stocks do want to invest directly, for example, because they think that they will be able to get some information about a particular company or hear something about a particular company and will be able to understand the business of the company. But it's not that easy. So you need to really bet on a particular business for a longer period of time to make a sustainable wealth for yourself. And I would say that that trend is changing now. As you rightly mentioned, about 2 years back, the total SIP book per month for the industry was about 2,500 crores. Today, as we speak, it's about 4,500 crores. And every month we are adding about 3 to 4 lakh new folios on the SIP side.
Wow.
If you look at the total SIP book today, it's at about 1.2 or 1.3 crore folios in the industry, whereas industry itself has about 4 to 4.5 crore folios. So I would say nearly 25% of those people who are there in the industry have come through SIP, which is a good sign. And that is also gaining momentum as we speak.
Sure.
So I think things are changing. Let's hope more people invest into equities.
Yeah, that's the endeavor of this show as well, Harsha, to get more and more people to invest into equities via mutual funds, which is probably the preferred route as opposed to trying it out yourself.
Yeah.
But thank you so much, Harsha, for taking the time out and joining us on this show. It was a pleasure having you.
Pleasure.
And viewers, thank you for tuning in on the Mutual Fund Show on Bloomberg Quint.